All right, welcome back, everyone. Today we're going to be talking about investing in blue chip stocks as well as investing in penny stocks. What? There are some rules for actually investing in penny stocks. So that being said, everyone, be sure to subscribe and ring the bell to be notified as soon as we watch or as soon as we drop a new video. Now, this is part 3, so if you're not subscribed to the channel, maybe jump back to those previous videos, or you could watch this one and then roll back to them. But that's why I want you to subscribe, because a lot of times we do these multi-part videos, we do live videos, etc. I want you notified as soon as we drop one. So today we're going to be talking about both, okay? Investing in blue chip stocks as well as small cap stocks. Now, when I say investing, actually, let me back up and give a little bit of framework, okay? In short-term trading land, and this is my philosophy. This is kind of everyone in short-term trading. We talk about day trading, okay? Day trading is in and out the same day, maybe overnight gapper, as we call it, okay? So a lot of the times, like, people think of overnighting a momentum stock as like a swing. Well, it's not really a swing. Basically, what we do with those gapper ideas is we're trading a strong momentum stock into the market close, like right into the market close, last 5 minutes, 10 minutes, maybe the last minute, to catch that follow through momentum the next day. And then at the end of the day, we're out the next morning, because these stocks that finish strong tend to gap up. We sell into the gap, okay? It's basically a day trading strategy. The main reason I teach that, the main reason people like it, is especially if you're under the pattern day trader rule, it gives you a lot more flexibility. So you take that strong stock right into the market close, it gaps the next morning, you're only in the trade a few hours, especially when you subtract the time the market's closed. So you're getting those day trade-like gains, you're getting those day trade-like exits without using your day trade. That's that. If you're under the PDT, if you've got a less than $25,000 account, you can only make 3 same-day round trips in a rolling 5-day period. But that, to me, is still a day trade, okay? You're in the trade basically less than 24 hours, okay? Then when we talk about swing trade, that's those multi-day trades, multi-week trades. That is, we're trading the momentum, we're trading the hype, we're trading the hot sector, but we're also setting our 3-to-1 risk to reward, and if our profit goal is hit, we move on. Okay, that's one of the biggest things about the swing trade methodology that I teach. We set our risk and we set our reward before entry using the stock chart. So if you want to get really in-depth on that, because I know a lot of you struggle with entries and exits, especially overstaying, click the link below. Check out StocksToTrade Live, okay? StocksToTrade Live, 1-hour webinars 4 times a day during the week, okay? In the morning, midday, afternoon, as well as the evening. A lot of them with me, a lot of them with Rob Booker, a lot of them with Matt Monaco, and we do so many of these webinars, so you pick the time of day that works for you and pick the presenter that connects with you. Maybe my style is a little different, so you go get on a webinar with Rob Booker. Maybe you like Matt Monaco's style better, you can jump on with him. So it's a great way to really maximize your trading education, and 100% live and on weekends too, by the way. So when we swing trade, we don't overstay. Our goal is hit, we move on. Now, when we're talking investing, that could be multi-week, multi-month, multi-month, multi-year. Hey, maybe if you're Warren Buffett, maybe it's multi-decade holds, and you're using more of a trailing stop methodology there, where you don't necessarily care if your goal is hit. You're going to set your trailing stop, and you're only going to exit the trade if it pulls back hard enough to stop you out for your profits, or if it's very early in the trade, maybe for that small loss. So one of the reasons we love to invest in blue chip stocks is the stability, okay? You don't see massive gap downs. You don't see massive dilutions. Not that it can never happen. Okay, listen, I remember when Steve Jobs died, okay? Big gap down on Apple, but within a few weeks, it was already back. But I mean, listen, when the founder, especially a founder like Steve Jobs, passes away, that's a very unique, that's a once once in a, if Apple's around 100 years, they've been around since the early 70s, already almost 50 years. I mean, if they're around hundreds of years, that might be a one-time event where somebody like Steve Jobs running the company passes away. So much more stable. They're safer during shaky times. I mean, hey, we know it's shaky out there right now. Inflation, the Ukraine situation, all this stuff going on in the world, a lot of bad news in the world. The larger cap blue chip stocks, they don't react as quickly to that. And when they do, they're quicker to recover. That's the nice thing. One of the things with penny stocks, and I so often preach this, you have to stick to your stops because, listen, some penny stocks never come back, okay? Like a lot of them run. We love them. We day trade them. But if you overstay and you become a bag holder, a lot of them never bounce. Like never, okay? They'll flatline for years, delist, and go away and never bounce. Where again, back to the Steve Jobs situation with Apple or Amazon when they missed on earnings a few months ago. Sure, they gap down, but they tend to grind back because the underlying business is so good. Dividends, hey, dividends are great. Never going to really move the needle, but it is also nice, something that I recommend is having a long-term holdings account and a short-term holding account so that you don't necessarily micromanage those long-term holdings. And it's always nice to log in and say, hey, couple percent dividend, grows your account, builds over time, always nice to see. No small cap, well, I shouldn't say no, very, very few small caps issue dividends. So the way we trade the blue chip stocks, the real stocks, we use technical breakouts on the chart. It's tied to the business, tied to earnings. The best time to enter any real company, any high-priced, high market cap company is around earnings. You have 4 times a year to enter. That's why we love the earnings winner strategy. Again, check out StocksToTrade Live. We go over, that's the great thing during earnings season. We go over the earnings plays live on these webinars. And then just use that trailing stop idea. Now, vice versa, we flip over to investing in small cap stocks. Remember I said investing. Okay, we talked about day trading in the earlier videos. We talk about day trading basically every video on this channel. But you can actually, blasphemy, invest in lower price stocks. Now, you have to do your due diligence and you have to find the small percentage that are cash flow positive, that are actually shipping stocks or shipping products, like have real sales. Ideally, you want to look for people that have an industry track record, maybe someone that came from an Amazon, maybe someone that came from an Apple or something like that. And you're going to want to avoid the low floats, okay? Low float stocks, as much as we love to day trade them, and when I say low float, less than 20 million shares in the float. The biggest reason we avoid those, they're heavily manipulated, okay? They're pumped, they're dumped, chat rooms, Twitter. Every pumper loves low float stocks because they can buy a few 100,000 shares, manipulate the stock, push them all over the place. And because of that, you're going to get stopped out if you try and hold these long term. Now, if it's a higher float stock, over 20 million, it's cash flow positive, debt is low, does not have a history of dilution, okay? You want to look for a history of dilution. Now, most cash flow positive stocks won't have a history of dilution. I mean, remember, stocks dilute. They sell stock because they have no other cash flow means. They sell stock to raise money, to stay in business, to pay payroll, to pay the rent, etc. So if you find those, now they're few and far between, but they're great trading opportunities. I mean, I would think of some of these battery plays, some of these EV plays. I mean, I remember like a BLDP, it was like $6, went to like $42 in a matter of months. They were cash flow positive. They had a lot, they were shipping products. They're few and far between, but if you like doing the due diligence, you like doing the research, they can be found. So that being said, everyone, if you want to understand the difference between all of this stuff and really get in depth, 100% live, 100% free, 4 times a day during the week, Saturdays and Sundays. Check out StocksToTrade Live. Would love to see you on a webinar.